Welcome to This Explainer. Today, we're going to talk about something you probably toss into your grocery cart every single week without a second thought. But we're going to completely reframe how you see it. We're throwing out the standard economic textbook today and instead looking at the true physics behind bread. Honestly, by the time we wrap this up, you're never going to look at the bakery aisle the same way again. All right, let's kick things off with a pretty jarring paradox. If I were to ask you right now, which of these is actually the fairer deal? A $2.50 white loaf from a mega supermarket or an $8.50 artisan sourdough from that little independent bakery down the street? What would you say? I mean, most of us have a gut reaction about the mathematical value of our food, right? But as you'll see in just a minute, that instinct, it might be entirely backwards. See, classical economics, those basic supply and demand curves we all had to memorize in school, tells us that the $2.50 loaf is an absolute bargain. It's a total triumph of modern efficiency. Meanwhile, that $8.50 sourdough, well, that's usually brushed off as just an overpriced luxury for foodies. We just kind of assume the market sorts it all out perfectly and that prices are just a pure reflection of what people are willing to pay. But what if those assumptions we're making in the grocery aisle are actually masking a massive systemic distortion? To really figure this out, we need a total paradigm shift. We're going to look at this through a concept called value physics. In this research, it completely turns neoclassical economic dogma on its head. It argues that real prices absolutely shouldn't be based on arbitrary monetary keystrokes. No, true value is anchored in undeniable physical laws. We're talking about the literal, physical difficulty of making the good, the thermodynamic energy consumed, and the actual human metabolic exertion required to produce it. So we're talking about biology, sweat, and physics here, not just some subjective pricing model. So how do we actually measure that physical difficulty? Well, enter the WEST token. That stands for work, effort, skill/time. Think of one single WEST token as exactly 1 hour of socially necessary baseline human labor. We're talking standard physical exertion, baseline danger, and normal cognitive load. It's essentially a way to calculate the literal biological difficulty of creating a loaf of bread. It gives us this really solid objective baseline metric that we can then use to evaluate absolutely any price tag you see on a shelf. And once we have that baseline, we get our ultimate measuring stick. It's called the Distortion Quotient, or DQ for short. It's pretty straightforward. It's just the ratio of the nominal shelf price to those WEST difficulty tokens we just talked about. So a DQ score of 1.0, that means perfect parity. The price perfectly compensates the physical effort and energy that went into the bread. But if the score is well below 1.0, it exposes some serious systemic labor exploitation. And if it's well above 1.0, well, we're looking at rentier capture. Basically, somebody is extracting tolls without actually doing any of the physical work. Let's actually apply this and see what it looks like. The researchers mapped out the entire Australian bread market across 4 very distinct tiers. So Tier 1 is your cheap private label stuff. Tier 2 is the big national commercial brands. Tier 3 covers retail franchise bakeries, and Tier 4 is your independent craft artisan bakers. When we map the whole market across these 4 tiers, from the cheapest generic bag to the fancy independent artisan loaf, and we calculate the DQ for each of them, well, the results completely shatter our assumptions about who is really capturing the value here. Okay, here is where it gets absolutely wild. That Tier 2 branded bread, it has a massive DQ of 1.228. These commercial brands are using the exact same automated factory lines as the cheap private label bread, and yet they are extracting huge markups. Why? Honestly, it's mostly for eye-level shelf placement fees and marketing. Now compare that to Tier 1 private label, which sits at a super low DQ of just 0.796. The supermarket is essentially selling it as a loss leader, what the paper calls the cover. That super cheap price is artificially subsidized by externalizing the debt upstream, which squeezes farm gate wheat prices down to catastrophic bare minimum levels. So let's go back and resolve that initial paradox we started with. Remember that $8.50 artisan sourdough? Turns out it requires nearly 18 minutes of direct human labor, masterful skill, and a grueling 36-hour cold fermentation process. That translates to 3.65 WEST tokens. That is nearly 8 times the metabolic difficulty of churning out a supermarket loaf. So with a DQ of 0.965, it actually isn't a ripoff at all. In reality, it is literally the most mathematically fair price in the entire economy. Crazy, right? Moving on to our next section, the macro shock, the interest rate trap. Let's zoom out for a second to the macroeconomic level. We're constantly told by textbook economic doctrine that when central banks raise interest rates, it suppresses demand and lowers consumer price inflation, and that includes food. But what if that is completely wrong when it comes to basic subsistence? Just consider this staggering figure, $110 billion. That is the total farm business debt in Australia, which is primarily held by broadacre grain farms. You see, modern farming requires massive, literally massive, upfront capital for land, harvesters, seed, and fertilizer. This immense debt vulnerability sits at the very start of our food supply chain. So what actually happens on the ground when the central bank hikes those rates? It triggers a very precise transmission cascade. First, farm debt servicing costs absolutely double, which pushes up the absolute minimum break-even cost just to grow the grain. Next, the industrial mills and commercial bakers face higher debt costs on their massive automated ovens and transport fleets. After that, supermarkets face higher commercial lease yields. And finally, every single one of those compounded costs is passed directly onto you, the consumer, via retail toll markups. So ironically, interest rate hikes are actually acting as a powerful cost-push inflationary driver. But here's the most perverse effect of this whole thing, which the research models as the Lorenz coercion factor. When rates go up, your mortgage goes up, which totally crushes your discretionary spending. You stop eating out, right? But you literally cannot stop buying basic calories. Demand for bread is perfectly inelastic. You have to eat. And this grants the supermarket duopolies massive leverage. Because indebted consumers are financially trapped into buying cheap staples just to survive, the supermarkets don't actually have to drop prices to attract foot traffic. In fact, they gain the absolute power to aggressively defend and even expand their own profit margins. To put some real numbers to this, the researchers ran a dynamic simulation. They modeled a 300 basis point rate hike on a standard $4 loaf of bread, and the results show exactly who is profiting from the inflation. The rate hike adds about 43 cents in pure debt and interest costs, which gets passed down the chain. But here's the real kicker. The supermarkets then use their coercive leverage to tack on another 35 cents in pure retail margin markups. And that brings us to this incredibly shocking conclusion. A 3% interest rate hike mathematically drives an immediate 19.4% increase in the nominal retail price of a standard commercial loaf of bread. Let that sink in. The monetary tightening policy that's supposedly designed to fix inflation is actually fueling corporate margin defense, and it's doing it entirely at the expense of your household's basic nutrition. Now, if you think that's bad, the long-term structural degradation is genuinely terrifying. The research calls this the reality gap integral. Here's how it plays out. Over a few months, farm debt doubles. After a year, supermarkets flat out refuse to raise that $2.70 private label cover price we talked about, which forces the farmers to just absorb all the financial pain. Fast forward to 3 years, and farmers are only surviving by skipping vital soil regeneration and delaying tractor maintenance. And at 5+ years, you hit what they call a terminal phase shift. Farms go completely bankrupt, and you start seeing sudden, discrete breakdowns in the actual physical supply of food. Let's look at the final section, Fixing the Food System, Sovereign Supply-Side Remediation. So the big question, how on earth do we actually fix this? Well, we have to insulate our basic food, our critical caloric substrates, as they put it, from the destructive spirals of monetary policy. The paper proposes 3 really distinct structural fixes. First up is statutory debt bifurcation. Now, that's just a fancy way of saying that the base capital required for essential food production is capped at a 0% real interest rate. Second, creating a public agricultural infrastructure bank. This would provide working capital and maintain a strategic grain buffer, completely bypassing all that private bank volatility. And third, breaking the supermarket duopolies by legally capping retail shelf slotting tools at a maximum of 15%. This entire architecture is designed to finally realign food prices with the true physical difficulty of producing them. Which brings us to our final thought for this explainer. Should our fundamental biological fuel, the stuff we literally need to survive, be subjected to the arbitrary whims of monetary policy and massive corporate shelf tolls? The true physics behind bread reveals a pretty harsh truth. The market doesn't actually value effort. It values leverage. I really hope this explainer has empowered you to completely rethink the true cost of absolutely everything you consume. Keep questioning things and keep learning.